What are you expecting from Tencent, and what's the company getting right, or is it just happenstance?
Yeah, I think most of the people on the street, including ourselves, are looking for fairly good online gaming business growth during the first quarter, given what's been happening, around COVID-19. And online advertising is also going to be fairly solid for Tencent. But what's going to be more important is to look at its e-commerce platforms as well as payment gateway, because we know for a fact that we did see some solid recoveries in March. But it'll be important to see their guidance for the second quarter and whether or not online platforms as well as the payment gateways are still going to be good. Because right now, Tencent trades roughly around 28 times forward earnings, which is slightly higher than its historical averages. So they really do have to surprise the market in terms of fairly solid Q1 numbers and a very good guidance for Q2 as well.
Actually, I'm looking at the valuation. It's at 33.7, that forward-looking PE. Does that deter you? As you just mentioned, it's a bit more expensive than its average. And who else you look at in this particular industry group?
Yeah, when you look at its historical 10-year average, its PE was roughly around 26 times. The way we looked at it was looking at 2021 as well as 2022 with a slightly higher earnings expectations, and that's kind of how we derived into 28, 29 times forward earnings. But again, that is still relatively a little bit more expensive if you compare with, let's say, Alibaba, who's roughly around 25, 26 times forward earnings. But with that in mind, within both the IT as well as the communication services sector, and particularly the communication services side, there's a lot of internet names which are trading sort of within the 15, 18 times forward earnings, which are sort of more about, let's say, social platforms, specifically search engines. So those look slightly cheaper. But then with that in mind, it's going to be important to see as a whole within the sector how strong of a growth they had during the first quarter and how guidance will be for the second quarter and for the remainder of the year.
Having said that, though, Ken, what do you make of the risks? I mean, we're seeing a resurgence in U.S.-China trade tensions, a resurgence perhaps also in the virus cases. Would that change the trajectory of the stocks and the markets going forward from here?
It would to some extent, because if you look at sort of where we are right now, most on the street are expecting for China to still have roughly around 1 to about 1.5% GDP growth for 2020. And if the trade war starts to, sort of happen again, and, earnings starts to deteriorate, and if we start to see growth starting to fall again in China, then definitely that's going to have an effect in terms of valuations and sort of overall pricing. So the markets haven't really fully priced in a potential sort of escalation of trade war again. So, we do have to be careful of the geopolitical tensions between China and U.S. in the coming weeks and months ahead.
How about negative rates? I know that the Fed has been reluctant to say that it is headed that way. In fact, it's been pushing back. But we have other central banks, perhaps even the RBNZ, perhaps considering negative rates down the road. How would negative rates impact how Asian assets trade?
Well, potentially that could be a benefit because, if we start to see negative rates, particularly, let's say, in the U.S., that could have a weakening effect of the U.S. dollar. And we know for certain that, when U.S. dollar starts to weaken, Asian assets tends to appreciate a little bit more because you start to see a little bit more of the capital inflow coming back into this part of the world. And we look at sort of year-to-date equity market performance, U.S. markets have started to outperform again versus its Asian peers. So anytime you start to see potentially negative rates coming, that could potentially bode well for Asia.
Ken, so tell me how your investment strategy is actually at the moment evolving. And of course, it's going to be informed by what's happening with this outbreak, but it's also going to be informed of what you think the world is going to look like after it.
Yeah, I mean, in addition to internet stocks, we look at IT stocks as well. And when we talk about IT stocks, a lot of the hardware suppliers and makers tied to smartphones and tablet-related businesses, could potentially do well. The sector, if you look at over the past 12 to 18 months, hasn't performed very well because of slowdown in overall smartphone demand. But now with the IoT in China sort of evolving, with 5G coming online, that could potentially bode well for a lot of the suppliers and makers for smartphones. And given their, sort of historically low PE valuations, that's really attractive. And also when we look at sort of some of the healthcare stocks, we know for a fact that, healthcare stocks have already done very well during the first quarter, but there's still quite a number of names, sort of when we look at, sort of some of the growth opportunities, looking at some of these regional healthcare services providers, they do look fairly interesting right now, given the fact that, sort of their business model continues to be, looking quite positive, in the coming months and quarters ahead.